Hello traders, welcome to our Friday recap. Right now it's 11:30 p.m. Eastern Standard Time. So just do a quick recap, and once again I do not have the chart app because my brokerage basically just shut down during the weekend, so I couldn't really pull up any chart. Just give you a basic fundamental recap. So today was very quiet. The only tier 1 data was the retail sale from UK during the London session. Now, there were 4 data in total. There were retail sale month to month, year to year, and core retail sale month to month, year to year. Now, this data is very important. As I mentioned, that the biggest risk after the Brexit was sterling depreciation, almost dropped about 20%. That was going to be reflected in the products, right? Because now your money becomes so cheap, so the producer have to spend more money to make a product, which they will basically reflect in the cost of the product, and then that will basically discourage consumption because people wouldn't buy it as much. That was the biggest worry and concern in 2016 after Brexit. A lot of economists predict that to happen. However, that did not happen back in 2016. But as I keep mentioning, that everything eventually will revert back to the fundamentals. So interesting things that sometimes you are right in the general directions, but maybe you are wrong at the timing. So that was the case back in 2016. A lot of economists, people were saying that they are wrong. It's not that they're wrong. It's just they kind of predict too fast. You have to always take into consideration of the human behavior. So unfortunately, that effect has slowly kicked in for UK economy this year. This is the second consecutive time that we saw a large drop, negative deviation for the retail sales. And this is a very worrying sign because pretty much right now, if this thing continue, there is no possibility for Bank of England to raise interest rate anymore. Because if this continues, the whole economy will really go into recessions. And that will be the biggest fear for UK economy. Of course, they still has this negotiation coming up with Eurozone, with US and things like that. They might still have some hope, but it really depends on especially the relationship between UK and Europe and how they like to maintain this business relationship, whether UK can still has this access, especially for the banking industry and financial industry. But just to show you that this is a very important, very worrying sign for the UK economy. Of course, that put a lot of downward pressure into British pound. The British pound, because of that, right now it's a very negative currency. Back then, I was saying that it's a neutral currency because we don't know how the Brexit, the negotiation is gonna go. But right now, fundamentally speaking, it's not looking well. So it right now, fundamentally, according to the data we have, I think it has shift. Right now, this is a structural shift for me, fundamentally speaking. So right now, I will put British pound as a negative currency. Other than that, there was no tier 1 data. The session started with a large risk of sentiment. We saw a large, tremendous buying into Japanese yen and Swiss franc. And this thing all the way until New York session, finally, sentiment shift a little bit, and then we end up with a much positive equity market for US from a very negative Asian and European market. So what happened right now, especially for US dollar, the interesting thing is that right now it's really this kind of moment when you have a divergence. So sentimentally, a lot of uncertainty, not only over the European elections, Greek date issues, but you also have this biggest risk factor in US, which is Donald Trump. This weekend is going to be a long weekend. So a lot of people, not only they don't want to hold any position for the long weekend, they actually want to hedge their position by buying some sort of safe haven currency, which is Japanese yen, Swiss franc. And that just show you how basically inconfident people are. Because don't forget, this week we have so much positive element for US dollar or for the global market. We start with fundamental data that were so positive for US dollar. One of the data, manufacturing data, I think it's Philly Fed manufacturing index. That was a large surprise. Was the best data since 1984. That's the fundamental side. The inflation also picked up tremendously. And then you have Jenny Yellen testify twice in front of the Congress, where she had a much, much hawkish tone. So US dollar, fundamentally and sentimentally speaking, was very strong this week. However, that was not the price action. The price action actually went to short it, to go against it. So if you ask me, this is really the divergence between fundamental and sentimental. Now, how would you trade in this way? A lot of people completely ignore it. They just trade technically. And that's why I say how you approach the market isn't really that important, like, to be honest with you. I think, of course, the more understanding you have, meaning the more knowledge you have, is always good and gonna be a favor for you. But how you approach it, or what you use to approach, is really not the key. The key is whether you approach it consistently. So for me, a lot of trade I took because of the fundamental analysis. And that's why I will stay within those trades unless the fundamental had changed. So unless I have sort of a structure change. For example, one of the trade I took beginning of this week is New Zealand dollar long. And back then, that was before Jenny Yellen testified. That was before this week's all the positive US data. So that trade was taken last week because I was still favor more into New Zealand dollar versus US dollar. However, this week, the inflation data, manufacturing index, and Jenny Yellen's testify completely shift the fundamental side of US dollar. And that's why I got out of those trades. So that just show you a quick example. That's basically how I manage the trade. So if I got in a trade fundamentally, then I will get out fundamentally. If I get in the trade, for example, some of my intraday trade that is more of a technical trading, then I will get out because of those technical shift. So it's really depend on your approach and whether you can be consistent with those approach. And that's actually my biggest issue even nowadays, always trying to be consistent with your approach. And that's why Water talk about the cycle of doom, which is very true. It's really the worst thing you want to do is to constantly change your approach, because at the end of the day you will not really have any significant result if you constantly change your method. So the current view, honestly, if fundamentally speaking, nothing really changed. For euro, it become really more negative for me. With everything, all the risk factors are still the same. You got this French election, Dutch election, Germany election, Greek debt issues, and the renegotiation with UK. But the thing is that we had more and more political drama into the French election. Now, Dutch election is important, but it's not, the stake is not as high as French election. The reason is because Dutch is not, it's very, very unlikely to have a Dutch exit. What happened is that Dutch is just too small, and the political situation is not that a big issue. Even the candidate that is more of an independent party, he is going to win according to poll, but it's not going to be big enough for him to have a Dutch exit. And as I mentioned before, if you're looking at the Eurozone's component, largest economy is Germany, and France comes in second. So any structure change in France will be a significant effect for Euro. And that's why the French election has a much higher stake in my personal opinion, I think it's a much higher stake than Brexit. So now they have more and more this kind of political drama. I don't really follow that closely, mainly because I don't speak French, so I don't really get to read news or enjoy this kind of sentiment firsthand. But just every day they will release the poll, and right now Le Pen still takes the lead, which is not a good sign if for people who don't want French to leave. So all this issue really, and fundamentally the ECB, this week we have the minute, they are really still very firm about the QE program. So only thing is just give a continuous of downward pressure for euro. Now for US dollar, as I already mentioned, fundamentally, sentimentally are very strong. So the only thing that is pressure it is this uncertainty over Donald Trump, especially when you have this kind of long weekend. Those things really is outside of my control. So for me, I don't take into consideration at all. That doesn't mean I'm gonna be right. On the contrary, a lot of time I'll get stopped out because of that. But for me, I don't really have any control to what Donald Trump is going to do or say. So for me, that's why I don't want to put that into my my risk factors, basically, because then it become a guessing game, right? So for my available information I have, I am still very bullish about the US dollar. British pound, as I mentioned, today the retail sale is, for me, it's a structure change in terms of the fundamental aspect. Right now, British pound has become a very negative currency. From previously, I gave it a neutral stance. Right now, it's a very negative currency. Canadian dollar, on the other hand, it had been supported today due to the weakening of US dollar. Sentimentally speaking and fundamentally speaking, the Canadian dollar is very strong. OPEC members' compliance is looking very promising. They also say that they are thinking to extend the program after May if the oil stock is still very high. And again, this Monday, Justin Trudeau and Donald Trump's meeting, that turned out to be quite well. Canada also signed a new trade deal with EU. That is another very beneficial thing. And the internal economic data, the GDP data, employment data continue to be strong. And that's why really for me, just looking at all this available information, Canadian dollar is still a very good currency to buy. For Australian dollar and New Zealand dollar, they both suffered today tremendously because the risk of sentiment. There weren't really any major updates. And for me right now, I was still leaning more bullish toward these two currencies, especially versus other weaker currencies. Because right now they are still very stable, politically speaking and fundamentally speaking. Yes, occasionally you have this kind of sentimental driven down, such as New Zealand dollar last week, RBNZ tried to talk it down. But nevertheless, currency is a comparison between pair to pair. So New Zealand dollar and Australian dollar they both are still very well supported. And I think perhaps the best part for these two currencies for this year especially is their political stableness. So back then they are very attractive due to the high yield status and their carry trade. But this year, on top of that, they become very, very stable, politically speaking, because US dollar has become a quite politically unstable currency. Euro is also unstable. Japanese yen, Swiss franc, they were okay, but now because of the US trading relationship, they become sort of unstable. So that will really leave you with Aussie and New Zealand. Both are still very attractive high yield currency. Both are geographically isolated in their own place, really just outside the turmoil that we have in 2017 so far. So that's why, if you think about it, a lot of people will want to put the bigger money in these two currencies, or basically to invest in these two countries. It's much safer that at least you know what is going to happen for them. Japanese yen, Swiss franc, of course, the two biggest winner today due to the risk of sentiment. Really not much to say about these two currencies because they're really just reactive to the sentiment. So they will have a big winning day, they will also have a big losing day. So for me, it's really hard to trade, especially if you're a swing trader. If you're a swing trader like me, I will be more bearish in these two currencies. But if you want to do intraday trade or session to session, you can always buy them in this kind of risk-off sentiment. So that's pretty much it for today. Again, today is a very light economic day, but we did have a lot of large price action due to a long weekend. I will do another Sunday update. Monday is a banking holiday for US and Canada, so it doesn't matter for me as a currency trader, because it's OTC market, everything is still moving. Money never sleep. That is true for a forex trader, but the liquidity will be thin. So just keep that in mind. Over the weekend, of course, you have the PPI data from Australia, and this is important. But because it's Sunday Asian session, it's pretty much not going to have too much movement. Monday is very quiet. The only thing you have is monetary policy meeting, which I don't think is gonna be a big mover. Since RBA has come out after the monetary statement to keep backing up their own currency, so this pretty much not going to give us too much fundamental change. Tuesday you have some consecutive of PMI from Eurozone, but nothing is too important as a tier 1 data. GDP price from New Zealand dollar will come out, and then you will have RBA government law speaks. Wednesday, the second estimate of GDP. Now, if it's a second estimate, it's not as important as the preliminary GDP. Core retail sale, this will be important for Canadian dollar. Now, noted that we do have a bullish bias, so if we can have another good data from Canada, that will really boost it up. On the contrary, if you have a negative data, that's still not going to put too much downward pressure. Just understand what's really affect Canadian dollar will be the oil market. FOMC meeting minute, I don't really think it's caused too much volatility, to be honest with you, because of Yellen's stance already. That's way more important. That's why this week's test fight by her, it was very important. Private capital expenditure from Aussie on Wednesday. And Thursday, you have unemployment claim. Not really a tier 1 data, as this is a usual data every week. And government law RBS speaks again. Crude oil inventory. And finally, finish with CPI from Canada. Now, again, just looking at the only thing I'm very interested to know is the retail sale and the CPI, especially CPI from Canada. If we can have another positive data, then that will really complete the picture. Now, understand, whenever you look at the fundamental data, the most important three elements is GDP, employment, and inflation data. These three data are really tells you pretty much everything about the country's economy. So if you don't have time to follow everything else, at least you have to look at these three areas, which is inflation, labor market, and GDP. If you have a country with three positive data in these three areas, now again, this is area. That means sometimes it's CPI, sometimes it's streaming data. It basically just all tell you something, right? Just different calculation, mathematically speaking. But if you have a country that have a pretty positive data outside these three areas, then that's the country or the currency that is going to be very, very bullish. On the contrary, if you have a country with three negative data in these three areas, that will be a very negative currency, fundamentally speaking. So that's why I say, if for me, no matter how strong Japanese yen is for a current session, it is still a currency for me to sell because their GDP is still very low. The inflation is still very low. The only thing good is that their labor market is very well supported because Japan has been known to have the lowest unemployment rate among the G8 nations. Same thing if you're looking at, that's why I say British pound was quite well supported back then. It's because their GDP was very, very good last year. Their labor market was also very well supported, and the inflation was also well supported. That's why you actually had more people wanting to buy British pound. So retail sale, it was not the biggest factor, but it will reflect in GDP. If you have a consecutive lower on consumption, and if that country's GDP, the largest component is the consumption, which is the case of UK and US and pretty much all the Western countries, then that will be a very significant effect. So for Japan, the biggest component of GDP is the export, and that's why the currency manipulation, if you want to call it, become very important for Japan to keep their currency low, because they need the export in order to survive. So it's just different component for you to see that which data will create a different effect. Okay, so that's pretty much it for next week. Again, I'll be back on Sunday opening just to give you another recap. But other than that, that's pretty much the update for Friday. And I think some of you pretty much gonna take a day off on Monday. So happy long weekend. I will see you very soon. Thanks for watching. Bye bye.